If you listen to the Tasty Live content for any length of time, it won't really take that long to hear us talk about managing at 21 days to go. I mean, if you've been watching the network at all today, pretty much any show, whether it be Tom and Tony in the morning, whether it be Liz and Jenny, after them, whether it be, the options trading live crew, whoever it may have been, whether it be Chris, kind of the futures power hour and stuff, you're going to hear us talk. You've heard us talk about managing at 21 days to go today. Like you've heard us talk about, why we like to manage at 21 days to go. We're at 21 days to go right now in the February cycle. And so today's the day, right? It's always that kind of that third Friday before expiration Friday. So why do we do this? Right? If you've been trading the Tasty way for a while, you already know all the reasons why. But if you're brand new to the Tasty universe, hey, welcome aboard. I hope that you stick around and continue to check out all the great programming that we have on the network. But you might be wondering, why do we manage at 21 days to go? Like, why is it so important for us to manage at 21 days to go? And again, if you've checked out any of the other shows earlier today, you've probably heard various different hosts and various different traders talk about why they like to do this. Well, I want to throw my hat in the ring too and say, well, this is why I like to manage at 21 days to go. So Ryan, go ahead and bring us into the content here today on this beautiful Friday afternoon. It's actually a little bit nipply outside. It's like 52 or 53. So at Tasty, we like to manage our positions, especially the undefined risk positions, at or before 21 days to go. And the main reason why is directional risk reduction. So if I had to summarize the reason why we manage at 21 days to go, and I only had one reason to give as to why we do that, it would absolutely be directional risk reduction. This is mission critical. This is top priority. Like, this is what we are trying to accomplish when it comes to managing our trades at 21 days to go. And so when I look at managing at 21 days to go, I look through the lens of primarily undefined risk positions because I don't really have that much directional risk exposure with a defined risk trade by the very nature of its being defined. So whether it be a vertical spread or an iron condor or a diagonal spread or whatever, there's obviously risk in the trade, of course. If I get it wrong, then it's going to hurt and I'm going to have to accept the loss and all those things. But I'm not really super concerned about those because as long as I size appropriately on order entry, keep the buying power to 1, 2, maybe 3% of my overall account value of my overall net lick, then I'm going to be fine. It's the undefined risk trades that, of course, we have to pay special attention to. And so when I think about 21 days to go, I think about undefined risk trades. I don't really think about defined risk trades. If we then, in addition to that, think about the profit drivers of any options position, it's basically going to come from one of three places. It's going to come from time, it's going to come from volatility, or it's going to come from direction. Now, if you really want to get super technical with it and get really granular with an option pricing model, like, yes, there are interest rates in there, but they don't really matter. Yes, there are dividends in there in the pricing, but they don't really matter either. They're a bit more transient and all stocks don't pay dividends. So it's like, well, how would I really, handle that? Time, volatility, and direction are going to be kind of your staples. They're going to be kind of your mainstays when it comes to thinking about how you make or lose money on an option position. Well, if we work through all three of these briefly, because I've talked about this many, many times on the show, even just recently, hopefully we'll kind of bubble up to the surface, the reasoning and the rationale as to why managing at 21 days to go is so important for what we're trying to do, or at least so important for what I'm trying to do with my undefined risk position. So time. By selling premium, we have positive theta. Right? By selling premium, we are able to tap into the simple passage of time, the option prices decaying, being beneficial to us. And that's it. That's all there is to it when it comes to time, right? We are able to allow the simple passage of time to work for us. And that's pretty much, a guarantee for all for all intents and purposes, right? I mean, I'm pretty confident that tomorrow is going to be Saturday. I'm pretty confident that in 3 days it's going to be Monday. And I'm also pretty confident that on Monday, the NASDAQ will be up another 175 points. Like, these things we just know. Like, these things are just super obvious. They're right out there in front of us. And so we want to tap into that. We want to take advantage of that. All right. That's pretty simple. That's pretty straightforward. What about volatility? So this is the other profit driver. Well, volatility, it's not going to be as, lock, stock, and barrel, Stone Cold Steve Austin certified as time was in terms of its certainty, in terms of its guarantee. It's going to be more of an expectation. It's going to be more of, some empirically derived, reliability when it comes to volatility's tendency to contract over time. Now, again, we're selling premium, we're selling options, we're positive theta. Okay, we just talked about that. Selling premium, selling options. We're also negative Vega or short Vega. Those would mean the same thing. If I'm negative Vega or if I'm short Vega, then I benefit from volatility contracting. I benefit from volatility going down. And we're actually seeing that here today. You've got the VIX down 50 cents. You've got /VX down, 50 cents or whatever. That helps our short premium positions. And so if we just, we're moving through the profit drivers kind of one by one. We're kind of moving through these guys in an itemized list. It's like, okay, I've got time. I feel pretty good about that. I've got volatility. I feel pretty good about that. Of course, volatility can spike, volatility can expand, and then that's going to hurt my current positions. Even though it might give me some additional opportunities with new trades, it is going to hurt my current positions. But still, I feel pretty good about that. All right, what about the last one? So this is going to be the wild card, right? This is going to be, the Ted Lasso special. Like this is going to be kind of the trick play, right? Direction. Market randomness dictates that this is going to be the biggest unknown. Again, time, I feel very good about that. Tomorrow's Saturday, then it's Sunday, then it's Monday. I feel pretty confident that those things are going to happen. Volatility, feel pretty good about volatility contracting in the long run, especially when it's on the higher end of the spectrum. But what about direction? It doesn't matter if you're positive delta or negative delta. It doesn't matter if you're playing the market higher or playing the market lower. Market randomness is effectively going to remain the biggest question mark in your own personal equation that's measuring the performance of your portfolio. It's measuring the P&L of your positions, right? And so when we think about that, it's like, okay, when it comes to controlling risk, what type of risk do I really want to control the most? Yes, I want to be aware of, my theta numbers. This is why we have theta ranges. Yes, I want to be aware of my volatility exposure. This is why, we might look at Vega to know how much volatility exposure I have. I don't really look at Vega that often because it's kind of included and baked into, your theta numbers, your overall extrinsic value numbers. But when it comes to direction, this is the risk that I really want to try to control. This is the risk that I really want to try to have, my finger on. So I'm very much aware of what I've signed up for when it comes to the different direction of moves in the marketplace. Okay. Well, underneath delta, which is going to be, the directional driver of my P&L, underneath delta, one of the second derivatives of the Black-Scholes option pricing model is gamma. Gamma shows you how delta itself changes when the stock price changes. And so what ends up happening is gamma actually gets larger in magnitude as you get closer and closer to expiration. And so, moves against you in the stock market, they're going to hurt more and more and more. And again, if we just trace back to delta being unknown, the direction of moves in the market being unknown, that is not really something that I want to, trade once, trade big when it comes to the direction of moves in the market. I don't really want to load the boat on one side to where I can really get hurt if I don't get the move that I want. Because again, the randomness and the unpredictability is going to be the governor of what's going on in the marketplace. And so when I think about that risk, and I think about gamma's natural tendency to rise as you get closer to expiration. This is the main reason why we all like to manage at 21 days to go. Now, there is other reasons like, profitability being more consistent in the first half of the cycle and, things like that. But when it comes to risk reduction, this is the main reason why I like to manage my undefined risk positions at 21 days to go. It's to keep that gamma risk in check. It's to keep that unknown variable, not necessarily completely overshadowing the time and the volatility, not completely overshadowing, the positive theta and the negative Vega. I want those guys to still be significant contributors too. I don't want delta to be so large and gamma to be so large that I'm just completely dependent and at the mercy of the market movement or lack thereof in my favor. So this is the main reason why I like to manage at 21 days to go. And I think every single trader, every single host at Tasty Trade would agree with this. And so this is kind of the main reason why we like to manage at 21 days to go. So Ryan, go ahead and bring us back into the portfolio here. So give me just a couple of minutes and let's take a look at the portfolio. And let's see what I have on that might require some management at 21 days to go. If you look at my positions, you're going to notice I really don't have that many at 21 days to go. I don't think I have any at 21 days to go that are undefined risk. And so EWZ, this guy's got 49 days to go. It's still in the middle of my strikes. I can move right beyond that. I don't have to do anything there. IBM, we just did this earnings trade the other day. It also has 49 days to go. It is still inside of my strikes. I'm going to sit tight and not do anything there either. Microsoft, This was an earnings trade too, I think a few days ago, and 49 days to go. It is in the money on the short call, but again, it's defined risk, so I'm not going to do anything here. We're going to sit tight and just kind of stew in the filth a little bit with that guy. Nike. So this was our put diagonal. We put it on, we took it off, and then we put it on, and now this is where we have, the current position. We're not going to do anything with this guy either because, if you look at, if I open up Nike and I open up XLE, these are actually going to be very similar analyses. So I'll go ahead and do these guys together. If you look at both of these strategies, you'll see they're almost identical. From the standpoint of they're the same strategy. It's a put diagonal, playing the market to the downside. They're a little bit different, of course, because different stocks, different strikes, all those things, but same expiration cycles, right? Back month is March, front month is February. And so when you look at, these two positions, I'm not going to do anything with the front month in Nike because there's still 80 cents of extrinsic value. So I'd like to see if I can collect most of that 80 cents of extrinsic value. And then that's for Nike. And then there's $1 in XLE. So I'd like to wait and see if we can collect, close to that $1 in XLE as well. And so I'm not going to do anything here. Could you take the 21-day rule and apply it here? You could. You absolutely could. But again, remember, right, I have kind of this overarching theme of how I like to use the 21-day marker. It's really mostly reserved for undefined risk positions. I don't like to meddle with my defined risk positions too much. I feel like a lot of times you end up kind of chasing your tail. You end up kind of biting yourself in the rear when it comes to trying to get a little bit too creative, a little bit too, proactive with your defined risk trades when, had you done nothing, you'd actually be in a better position. And so I've just, I've had to learn that lesson the hard way, I suppose. And so that's just my overall kind of modus operandi when it comes to defined risk. So Nike and XLE, I'm not going to do anything for all of those reasons. And then if we look at, the Qs, we looked at the Qs just recently, but this is a short call spread that's in the money. It's fully in the money. We're at 21 days to go, but if I right click and try to roll this guy, you can see I've got to pay a 24-cent debit. And I don't really want to pay a 24-cent debit just to lose more because the NASDAQ is never going down again. Right? We're never going to see below 12,000 again. Like, it's over. It's done. Like 20,000 is your next tick. And so I don't really want to add more risk to the trade when the market is clearly never going down again. And so that's the Qs. And it just feels so wrong. It feels so wrong to be in a sour mood when the market's up 150 points. But thus is the life that we have to accept at this point. So SPY. So this is my broken wing butterfly. This one is interesting because we looked at this guy yesterday, right? And so what I want to do here is if this $4 wide spread, and I'm just going to go through these last two positions, and then we're going to get to y'all's questions here in just a second. So just give me a couple more seconds. If I go into this long call spread, you can see that if I close out of this long, that's pretty close, man. Like, that's really close. So during yesterday's show, I talked about how, hey, if I can get near max value on this long call spread, then I'm going to take it off. Well, the long call spread's max value is $4, right? You can see right now, at least according to the mid price, I can get out for $357. I kind of said yesterday, about 360 would be pretty good. So I don't know. I feel like it's time to go ahead and close out of this long call spread, and then we just deal with the short call spread kind of on its own. We're still going to be bearish in SPY. We're still going to need SPY to come back down, underneath our strikes, preferably. But I'm going to try to close this guy, and we'll see if I can get filled, at this mid price. Then I'll go ahead and take it. I'm not gonna give up too many pennies because that's kind of right on the cusp of what I'm looking to collect anyway. So let me see if they'll get me out at 357. Wow, filled immediately at 357. So there you go. So we're out of one portion of the broken wing butterfly and SPY. We were able to extract $3.57 out of a maximum $4 from that long call spread. So we gave up, if you will, 43 cents in potential max value on that long call spread. So, it's important to understand that 43 cents that we lost, that does effectively increase our risk in the overall trade. So on entry, I can't remember what the max loss was off the top of my head, and we could work it out, but I don't really feel like working it out. And so when you look at the max loss on the trade, you add 43 cents to that max loss because, the max loss calculation on entry for any defined risk trade, it is talking about at expiration, It's talking about at that moment in time, and all the extrinsic value is gone from the option. So if the underlying stock, in the case of this broken wing butterfly, if SPY was higher, then you would be able to sell out of that call spread for effectively $4. Well, I didn't sell it out for $4. I just sold it out for $3.57. So that 43 cents that I lost, that I missed out on, that's going to be added to my total potential loss in the trade. And so that's SPY. And then UNG, wow, look at natural gas. I mean, natural gas is just getting gorilla smacked. I mean, this thing is down to 960. And so that's pretty wild, man. We are out into April. I remember we did this and the March cycle was not available. So we just had to engage with some leap options. It was really our only choice. And so, so March is at, or UNG is in the April cycle. We're far below our 12 put. I think we're going to go ahead and, again, we're not at 21 days to go, so there's nothing to do from that regard. But I do think, let's just go into April. Let me look at this really quick, and then we'll get to some questions. Man, I mean, I could roll from 21 to, 16, but I'd only pick up another 15 or 16 cents. That doesn't really make any sense to me, pun intended. And so, I'm just going to sit tight. I'm not going to do anything with this trade. I'm going to sit tight. We're going to do nothing. I like having the space between the strikes. There's a ton of time left. I'm not super concerned about this. Besides, I'm pretty sure the lowest UNG can go is 0. Although I'm not 100% sure, because a couple years ago, oil did sell for negative $37 a barrel. So when it comes to storage costs and things like that, sometimes the algos go a little crazy, and they'll give you a little bit of oil and a little bit of cash if you go ahead and buy the product. So there you go. So there's the 21 days to go. That's why we do it, and kind of just a brief overview of my portfolio.